Hi, welcome to this quick tutorial about the sales mix and break-even at multi-product companies. The sales mix is the combination of products that make up total sales. All else being equal, the company earns more operating income by selling high contribution margin products. The weighted average contribution margin weights each contribution margin by the relative number of units sold to come up with this overall weighted average contribution margin. So we're going to go through an example. We're going to use the sales mix for a bicycle manufacturer. So what you're seeing on the screen is sales and cost data that is given to us. And we need to remember that all of this data is hypothetical. So we have a bicycle manufacturer selling three types of bikes: traditional bikes, electric bikes, and tandem bikes. We're given the unit sales of each: traditional bikes 250,000, electric bikes 300,000 units, tandem bikes 200,000 units. So the total units being sold 750,000. Now we're also given the average sales price per unit. So this is an average. So traditional bikes $500, electric bikes $2,000, tandem bikes $1,500. And we have an NA at where the sum would normally be, because we wouldn't sum those. That would make no sense. And then we have the average variable cost per unit, which is given to us as well. And it is $375 for the traditional bikes, $1,200 for electric bikes, and $1,050 for tandem bikes. Again, no total, because to sum them would not be meaningful in any way. So step one, we're going to calculate the percentage of total sales for each product group. Remember, we're trying to get to the break even for a multi-product manufacturer. So our first step is to calculate the percentage of total sales for each product group. To do that, for example, traditional bikes, we're going to take the unit sales of 250,000 units divided by total units of 750,000, and we get 33.3%. Then for electric bikes, we would take the 300,000 unit sales divided by 750,000 total sales to get 40%. And then finally for tandem bikes, 200,000 unit sales divided by 750,000 total sales, 26.7%. Okay, so that's step one. Next up, for step two, we're going to calculate the average contribution margin per unit for each product group. And to do that, we're going to take our average sales price per unit, which is in column D, and subtract the average variable cost per unit. So for traditional bikes, our average contribution margin is $125. That is the $500 sales price minus the average variable cost per unit of $375. For electric bikes, we take 2,000 minus 1,200 gives us 800. And then finally for tandem bikes, we take 1,500 average sales price minus the average variable cost per unit of 1,050, and we get $450 as the average contribution margin per unit. Again, we do not add those up, because those numbers, that sum would not be meaningful. Next up, we're going to calculate the contribution margin ratio for each product group. So to do this, we're going to take the average contribution margin per unit divided by the average sales price per unit. So we're taking the data in column F and dividing by column D. So for traditional bikes, we would take $125 divided by 500 to get 25%. For electric bikes, we would take 800 and divide by 2,000 to get 40%. And then finally for tandem bikes, we would take 450 divide by 1,500 and get 30%. So let's keep going. Now we're going to calculate the weighted average contribution margin for the entire company. So let's start by calculating the contribution margin ratio for traditional bikes times the percent of total unit sales for traditional bikes. So what we're going to do is we're going to take, for example, the contribution margin percentage of 25% times the weight of 33.3%, and we get 8.3. We're going to do the same thing for electric bikes. We're going to take 40% times 40% and get 16%. And then finally, for tandem bikes, we're going to take 30% times 26.7% and get 8%. So our weighted average contribution margin turns out to be 32.3. We would add those three numbers together. Now, something to note, the way we've done this here, the only number that is needed from column H is 32.3%. Those individual weighted average contribution margins are not meaningful. We do not need them for anything. We're using them to get to that 32.3%. So what do we do with that? So let's continue our bicycle manufacturer. Let's say the fixed costs at the bicycle manufacturer are $60,000. To calculate break-even sales, we would take the $60,000, which is the fixed costs, and divide by the weighted average contribution margin ratio of 32.3%, and we would get approximately $185,759. Okay, then what? Then we can take that total break-even sales that we just calculated and multiply that by each of the weights for each of our product groups. So for example, traditional bikes, we're going to take the 33.3% weight that we had calculated earlier times the total break-even sales and get $61,920 of break-even sales for traditional bikes. Then for electric bikes, we're going to take the 40% weight that we calculated earlier times the $185,759 again to get break-even sales of electric bikes of $74,304. And finally, tandem bikes, 26.7% weight times $185,759 to get $49,536 as the break-even sales of tandem bikes. So that is what we do to calculate break-even at a multi-product firm. We can get the total sales, and then we can break that down into how much sales of each of our product groups. Remember that the cost estimates we use are only valid within the relevant range. The relevant range is the band of volume where total fixed costs and the variable costs per unit remain constant. Okay, that's it. We are done. This video was created and narrated by Dr. Wendy Tietz. Have a great day.